Every global market today is built on one hidden assumption: oil will keep flowing. But there is a single choke point that can break this assumption overnight: the Strait of Hormuz, a narrow corridor between Iran and Oman. At its narrowest point, it is only 21 miles wide, and yet, this thin waterway carries the lifeblood of the modern global economy. Nearly 1/5 of the world's oil supply moves through this corridor every single day. That is roughly 20 million barrels of crude oil every 24 hours. Now imagine something different. Imagine the ships stop moving. Imagine the corridor closes, not partially, completely. What happens next is not just an oil shock. It becomes a global financial shock. Energy markets explode, inflation returns, central banks lose control of policy, and the entire valuation model of global markets changes overnight. But here is the deeper question: would the global economy actually collapse? Or is this fear overstated? To answer that, we need to examine the system step by step. Layer 1: the energy choke point. The Strait of Hormuz is not just another shipping route. It is the most critical energy corridor on the planet. Oil exports from several major producers depend almost entirely on it: Saudi Arabia, the United Arab Emirates, Kuwait, Iraq, and Iran itself. Together, these countries account for a massive share of global energy supply every day. About 20 million barrels of crude oil pass through this narrow passage. That is roughly 20% of global oil consumption. If this flow stops even temporarily, the supply shock would be immediate. Energy markets operate on tight margins. There is very little excess supply in the system, which means even small disruptions can move prices dramatically. A major disruption could trigger something far larger. Layer 2: oil price shock. Oil prices are not determined only by physical supply. They are also shaped by expectations, risk, and financial speculation. If traders believe the Strait of Hormuz could close, they begin pricing that risk immediately. Insurance premiums surge, shipping costs rise, speculative capital floods into energy markets. Historically, geopolitical shocks have caused rapid spikes in oil prices. During the 1973 oil crisis, prices quadrupled. During the Gulf War, they doubled within months. In a severe disruption scenario, many analysts estimate oil could surge well above $100 per barrel. Some extreme forecasts suggest $120 or even higher. At that level, energy becomes a macroeconomic shock, not just a commodity story. Layer 3: inflation returns. Oil is not just another input. It is the foundation of the entire global production system. Energy costs affect transportation, manufacturing, agriculture, and logistics. When oil prices surge, those costs spread through the economy. Economists call this cost-push inflation, and history shows the transmission is powerful. Higher fuel prices raise shipping costs. Shipping costs raise retail prices. Retail prices feed directly into consumer inflation. In other words, oil shocks do not stay inside energy markets. They leak into everything. For central banks, this creates a dangerous problem because inflation is the one variable they cannot ignore. Layer 4: the central bank trap. For the past 2 years, global central banks have been trying to achieve one thing: lower inflation without crashing economic growth. This delicate process is called a soft landing, but energy shocks can destroy that plan. If oil suddenly jumps, inflation rises again. And when inflation rises, central banks lose the flexibility to cut interest rates. Instead, they may be forced to keep policy tighter for longer. That changes the entire environment for global markets, because modern asset prices are built on interest rate expectations. Layer 5: asset market repricing. Low interest rates support high asset valuations, especially in technology stocks, growth companies, and speculative sectors. But if inflation rises again, and central banks delay rate cuts, the valuation model changes. Discount rates rise, future earnings become less valuable, and markets begin repricing risk. Historically tight monetary conditions have triggered sharp corrections in equity markets, not necessarily because profits collapse, but because valuations compress. In other words, the danger is not just higher oil prices. The real danger is the policy response that follows. But here is the critical point. A complete shutdown of the Strait of Hormuz is extremely unlikely, not because the region is stable, but because the global system has powerful countermeasures. First, major powers maintain a permanent naval presence. In the Persian Gulf, the United States Fifth Fleet is specifically tasked with protecting maritime routes. Second, oil producers maintain alternative pipelines. Saudi Arabia can reroute some exports through the Red Sea. The United Arab Emirates operates a pipeline bypassing the strait entirely. Third, governments hold strategic petroleum reserves. These reserves exist for precisely this scenario. If supply disruptions occur, millions of barrels per day can be released into the market. All of these mechanisms reduce the probability of a complete shutdown, but they do not eliminate risk. Because markets do not wait for events to happen, they react to the possibility of events. And that is why the Strait of Hormuz remains one of the most important risk variables in the global financial system. It is not simply a geographic location, it is a pressure point inside the global economy. And whenever geopolitical tensions rise, this pressure point returns to the center of market attention, because in a world built on constant energy flow, one narrow waterway still holds enormous power.